Hey everyone, let's fix the MA labels first. My bad earlier. It's white equals 6-month MA, green equals 1-year MA, yellow equals 18-month MA, red equals 2-year MA. Now let's dive back into this gold daily chart, tying it to 2025's global macroeconomy. Why is this rally so enduring? Why do slopes swing from mellow to steep? Macroeconomics is the real hidden driver. 1. Trend structure. A step-by-step bull market fueled by macro. Gold's 2018-2025 move is a three-stage ride. Macro logic kicks in, gives technicals confirm, gives money floods in. Every upswing locks into key macro beats. 1. Bottoming phase 2018 MID 2022. Strategic buying amid macro jitters. The world was all over the place back then. U.S. trade protectionism heated up, China-U.S. tensions rose, and after the Fed's aggressive 2018 rate hikes, markets started betting on looser policy. Global cash scrambled for safe havens. On the chart, prices bounced around lows, while the 6-month white, 1-year green, 18-month yellow, and 2-year red MAs shifted from scattered to converging upward. That's sovereign funds and central banks quietly piling in. WGC data shows central banks bought gold nonstop. They were hedging against shaky dollar credibility and rising geopolitical risks, laying the groundwork for the bull run. 2. Rally kickoff mid-2022 to 2024. Macro meets technical breakthrough. From 2022 onward, macro drivers went full throttle. The Russia-Ukraine war sparked safe haven buys. The Fed's brutal rate hikes to fight inflation shifted to rate cut hints in 2023, and de-dollarization picked up steam. Dollar's share in global reserves kept falling. Technicals followed suit. Prices broke out of a long consolidation, rallying steadily along the 6-month white and 1-year green MAs with a gradually steeper slope. That's institutional money pouring in. Macro-wise, gold had 3 winning cards: inflation hedge, safe haven, de-dollarization. Technically, MAs formed a bullish alignment, and every pullback to the 1-year green MA was a buying chance. The rally had serious staying power. 3. Accelerated sprint, late 2024 to 2025, macro hype plus emotional frenzy. 2025's macro backdrop is gold's dream. The Fed cut rates twice down to 3.75% to 4% and stopped quantitative tightening, fueling global liquidity hopes. Meanwhile, Middle East and Russia-Ukraine conflicts dragged on. The IMF cut global growth to 2.7%, and safe haven demand stayed red hot. Most importantly, central bank gold buying surged 220 tons in Q3 2025, with 43% of central banks planning more purchases. On the chart, the slope spiked to nearly 70 degrees, prices soaring away from the 6-month white MA. That's retail investors and short-term traders chasing the hype. Macro logic rate cuts plus safe havens plus central bank buys lit a fire, and technical breakthroughs amplified gains. But it's also sowing seeds of a pullback. Short-term overbought conditions and profit-taking pressure are building. 2. MA code. Macro money's cost consensus. With the correct MA labels white, 6-month green, 1-year, yellow, 18-month, red, 2-year, each MA is a cost floor for different macro players, backed by solid logic. 1. 6-month MA white, institutions policy radar. This is institutional investors' 6 to 12-month holdings policy compass. The Fed's 2025 rate cut pace and inflation data swing their gold positions. When the Fed hints at cuts, institutions push prices up along this MA's steady slope, means policy expectations match money flows. If hot inflation sparks rate hike fears, prices may test this MA, but as long as rate cuts are on track, institutions will step in to buy. 2. 1-year MA green, long-term money's safety net. This is the macro floor for long-term investors' 1 to 2-year holdings, rooted in de-dollarization and geopolitical risks. In 2025, central banks keep buying gold and reducing dollar reserves. This trend keeps the 1-year green MA rising, acting as the bull run's anchor. Even above $4,000 per ounce, central banks don't stop. They're safeguarding financial security. As long as this MA holds, gold's long-term bull case stays intact. 3. 18-month yellow and 2-year red MA super long-term money's big picture. These are strategic cost lines for sovereign funds and central banks, reflecting global economic restructuring. The 2-year red MA's upward trend mirrors the end of dollar dominance. OMFIF predicts the dollar's reserve share will drop to 52% by 2035, boosting gold's value as a non-sovereign asset. The 18-month yellow MA's support ties to geopolitical endurance, with conflicts ongoing and global nuclear warheads rising for the first time in 30 years. Super long money holds tight, making this MA a rock-solid support. 3. Slope secrets. Macro sentiment thermometer. Slope changes show how intense macro sentiment is and how fast money is flowing. Different slopes mean different macro scenarios. 1. Gentle slope, 2022, early 2024, 40 to 50 degrees. Macro logic unfolding steadily. A steady, slow climb matched gradual macro progress. Fed near the end of hikes gives rate cut hopes. On again, off again geopolitics and steady central bank buying. Institutions called the shots here, slowly rallying and pulling back to the 1-year green MA to shake out weak hands while waiting for macro confirmation. For traders, this was the sweet spot: clear macro logic plus solid technical support. Pullbacks to the 1-year green MA were low-risk buys, backed by both macro and technicals. 2. Steep slope, late 2024 to 2025, nearly 70 degrees, macro hype overdrive. A sharp slope means macro sentiment went wild. Fed rate cuts landed, central bank buying surprised to the upside, geopolitics worsened, markets shouted, gold only goes up, drawing short-term traders and retail. But this slope is risky. Macro expectations are overstretched. The Fed has limited room for more cuts, and any de-escalation in conflicts could trigger a quick exit by speculators. Technically, prices are way too far from the 6-month white MA mean reversion. Pullback to longer MAs is inevitable to cool down overheated expectations. 3. Consolidation ahead. Macro reckoning plus technical repair. After a steep run, consolidation is all about balancing macro expectations. Markets wait for the Fed's next move and geopolitical updates while profit takers lock in gains. If macro logic holds, rate cuts plus safe havens, prices will stabilize quickly after testing the 1-year green MA and rally again. If macro shifts, for example, inflation sparks rate hike fears, we may see a deeper pullback to the 18-month yellow MA, but as long as the 2-year red MA climbs, de-dollarization and central bank buying will limit losses. Adjustments are just opportunities. 4. Hidden risks and opportunities. Macro plus technical confirmation. For real trading, you need both macro and technical signals to align, otherwise it's a low probability bet. 1. Risk signals. Macro shift plus technical breakdown. Macro, Fed unexpectedly turns hawkish, pauses cuts. China-US trade tensions ease, geopolitics cool down, safe haven demand dries up. Technical, prices close below the 1-year green MA for weeks and the 6-month white MA turns down. That's a double whammy: macro expectations reversed plus money fleeing. Cut positions fast. 2. Opportunity signals. Macro plus technical alignment. Short-term, stable macro, Fed stays on rate cut path. Prices pull back to the 6-month white MA with shrinking volume. Light positions for a quick bounce. Medium term, macro gets stronger, better than expected central bank buying, geopolitics worsen, prices pull back to the 1-year green MA with bullish candlesticks. That's institutional money buying, ideal for medium-term positions. Long-term, macro trends hold, de-dollarization plus global uncertainty, prices test the 2-year red MA and stabilize. That's a strategic buy for super long funds. Go big if you're in it for the long haul. 5. Wrap up. Macro sets direction, technicals time entries. Here's the core. Macroeconomics decides gold's long-term direction, rate cuts, plus de-dollarization plus safe havens, while technicals, MA slopes, consolidation, dictate the timing. Trade with macro as your foundation and technicals as your guide. Long-term investors, watch the 2-year red MA plus macro trends. As long as the Fed's rate cut cycle continues, central banks keep buying, and de-dollarization persists. Hold on, short-term swings are just noise. Medium-term traders, focus on the 1-year green MA plus policy events. After Fed meetings or WGC data releases, buy on pullbacks to the 1-year green MA if it holds, sell if it breaks. Follow the macro rhythm for swings. Short-term traders, stick to the 6-month white MA plus sentiment. Buy when prices rally along it, dip buy on pullbacks, and take quick profits. Don't fight the macro trend, never short gold in a rate cut cycle. Simply put, this gold chart is a technical mirror of 2025's global macroeconomy. MA support reflects macro money's consensus, slope changes show sentiment swings, and consolidation marks macro expectation rebalancing. Nail, this analysis is based on historical charts and macro data, not investment advice. Gold trading is risky. Geopolitics, policy shifts, and liquidity can trigger big moves. Trade wisely.